Speculation and income inequality. Speculation is the making of money out of the manipulation of prices instead of supplying goods and services. It brings economic bubbles. Economic bubbles occur when the prices of assets exceed their intrinsic value by a considerable margin. A speculative bubble is essentially a social epidemic. Speculation involves trading a financial instrument involving high risk in the expectation of significant returns. The motive is to make maximum advantage from fluctuation in the market. Speculation increases the price of goods that people need for their benefits. It is a bad idea. The biggest cause of the stock market crash was speculation. As prices began to rise for stocks, more investors wanted to buy to make sure did not miss out on great investment. This meant that as the stock prices started rising more, people were demanding more stocks, which caused the price to rise even more. Speculation are prevalent in the markets where price movements of securities are highly frequent and volatile. Speculation is not good for the economy. It is actually really bad. It has completely distorted our economy by diverting money and investment away from productive enterprise and businesses and into unproductive assets. A price is the compensation given by one party to another in return for one unit of goods or services. A price is influenced by both production cost and demand for the product. A price must be determined by the corporations or may be imposed on the firm by market conditions. A share price is the price of a single share of a number of sellable stocks of a company, derivative, or other financial assets. In layman's terms, the stock price is the highest amount someone is willing to pay for the stock, or the lowest amount that it can be bought for. The stock price only tells you a company's current value of its market value. The trading of the stock exchange is done on the market value price, which depends on speculators. Why was above mentioned the present order which defines the price of a stock and the negotiate influence of the securities of their use? That is why I wanted to convince the readers about all shortcomings in the present market economics in connection with this. It is like a casino which satisfies most of all requirements of the speculators than investors. If we want to affirm that the stock market is a form of investment, We should declare that stocks are not goods, but a share of actual cost of a corporation with a calculation of profit or losses on a definite period, which should serve as a basis for exchange in the market. This will bring a full change in the market economy. All citizens will become investors. No more bubbles in the market. No more divert money and investment away from productive enterprise and businesses. Eliminates income inequality. Eliminates economic crisis. Regulates well social problems. Reflects correctly the index of wealth growth. By investing their savings in pension funds and stocks, working people expect to get a share of corporate profits in addition to their earnings. It is reasonable that such profits go hand in hand with some risk of failure within a few companies. Besides, they help corporations fulfill their needs for a constant increase of production. These stock prices need to reflect the results of the public company's activities and fluctuate within the boundaries of collected profit or losses for every stock. As a result, the price of a stock becomes a derivative of fluctuating profits. Over a long term, stock prices rise in line with earnings per share. The profit or losses of companies reflect a complex and final result of their activities, taking into consideration the quantity and quality of production, its sales, productivity, cost price, and other economic, political, and social charges for a corresponding period. Therefore, it is unacceptable that the daily abrupt, not well-funded ups and downs can scare away investors from buying stocks. Stocks are not goods, but valuable papers which reflect the accumulation of profits on a definite date. The price of a stock should be established by the public companies by means of bookkeeping calculations, by adding the profit of a given quarter divided by the amount of shares to the price of the stock from the time when the stock was issued, for example, initial public offering. Thus, not the stock market, but the public corporation sets the price of their stock and bears the responsibility of their substantiation. One would think that such organization of the stock exchange satisfies the requirements of capital investment. In reality, the stock market operates on an order established 200 years ago. For example, the price of a stock is what somebody is ready to pay for it. This way, the traders, speculators, enrich themselves on the stock market on the account of volatile movements of stock prices. They make money when the prices go up and down by means of increased frequency of buys and sells. The investment business is a giant scam. It delays billions of dollars every year in transaction cost. They artificially violate the balance of supply and demand that doesn't apply to stocks, so that they can make everyday billions of dollars, enriching themselves on the backbone of ordinary investors. For the average investor, this is certainly a scam. They know that big investors manipulate the market. Market forces can accomplish wonderful things if the price is set to its value. They can ensure a distribution of income that enables all citizens to meet basic economic needs. To pretend that nothing changed from the time of the start of capitalism is to put a brave face on a sorry business. The CEO of corporations, which are the same employees like all others, take away a big share of corporate profits, about 50 million, as premiums and bonuses, and for all that they don't risk at all with their capital. This is, frankly spoken, a robbery of the company, the workers and shareholders. This has to come to an end. The new situation in the 21st century requires a new approach to the distribution of income. Under the new existing conditions, it is necessary to establish new norms promoting the implementation of necessary economical requirements of all levels of the population. Wages should be coordinated with the results of productivity of labor and inflation. It is necessary to establish an order of distribution of profits by public corporations. The concrete definition of a correlated percentage should be worked out by a scientific research institute. However, it seems to us that it is advisable to distribute profits exemplarily in the following way. For scientific research and development, 50%. For financial incentives of members of corporations, 25%. Dividend for stock shareholders, 25%. The collectives of companies' workers should get awarded for yearly results. The premiums and bonuses for CEO, CFO, and other leading personnel can be of any reasonable dimension, but should be coordinated with the final results of corporations, not for a year, for a 5-year period. In addition, it is unreasonable to expect a fair distribution of income among the population until the deceptive price of market price determination is in hands of speculators. The stabilization of prices the removal of speculators from the markets, together with recommended distribution of profits, referring our affirmation, is equivalent to establish justice in income distribution, which equivalents to establish a new phase of capitalism where all levels of the population makes use of the advantage of the capitalistic and democratic systems, smoothing over conditions in the distribution of income. Michael Zilbering.